the first key takeaway is not to panic here. I think it's given what's happening in the markets, people say, well, I need to do something about what's happening. And often the best advice can be sit on the sidelines and actually just watch what's happening. What you are going to see in the market now is real world effects. Companies are going to be going bankrupt and going to be put under a lot of pressure. And so I think you need to be cognizant of that. And if you look back over South Africa's history, we haven't really traded this cheaply in probably nearly 40, 50 years. You probably shouldn't be selling equity here. You should be buying more equity if you've got cash.
Good day. I'm Hamilton van Breda, Head of Retail Sales at Prudential Investment Managers. And with me today, I have got Ross Biggs, Head of Equity. And Ross is going to give us some insight into the fall in the equity market over the last month or so, and what Prudential is going to be or is doing about that asset class. We've seen a massive unprecedented sell-off in the global equity market, the US and the rest of the world, as well obviously as the South African market. So Ross, this begs the question, what would be the immediate and then longer term impact of the pandemic on the market? Particularly looking at, say, the different sectors of the market.
Yeah. So I think what you first need to do is distinguish what is happening in the market at the moment compared to what happened in the global financial crisis. So in the global financial crisis, what we had there was the financial markets having an impact on the real world economy. What we have today is the real world economy having a very big impact on financial markets. So you've got a lot of companies globally who are worrying about their revenue over the next 6 months, 12 months, 18 months. And that's caused a worry about earnings and balance sheet risk for companies in the real world. So if you look at hospitality companies today, you look at airlines, they're worrying about whether their balance sheets can actually weather the next 3 months, 6 months, 12 months. And that's obviously very concerning for them. And what they often do is they do a sort of a worst case scenario. So if we go back 2 months ago, the markets were sort of saying, this is something that we can recover from over the next 3 months. What we're looking at now is companies saying, actually, how long could this take? It could take 18 months. It could take, things might only return to normal when we have a vaccine for the coronavirus. The issue for companies today, real world companies, is how strong is my balance sheet? What are my cash flows going to look like over the next few months? And that is what the financial markets are trying to grapple with at the moment. They're trying to just decipher which companies actually are going to see it through to the end of this versus those companies that could see permanent capital damage or loss.
So Ross, in 2008, you could have hidden in gold stocks. Our market today has fallen across the board. Maybe take us through the impact on the different sectors.
Yeah, so what is critical to realize is that companies today are worrying about their balance sheets and liquidity. And so it really is a liquidity event. People are seeing their working capital getting stretched to large levels that they would have never sort of forecast. And so the real world today is saying, I need cash urgently. I need to be able to pay my creditors. I need to be able to pay my staff. They're grappling with questions of, how long do I ask my staff to sort of go on holiday without a salary? And so it's a fight for cash. And that sort of need for liquidity has filtered through into the financial markets. So today, the financial markets are going, we need liquidity. And what we saw a few weeks ago was initially the markets go, well, actually, we see there's a problem happening in the financial markets. Let's go hide in the quality assets. So let's go hide in cash. Let's go hide in US high yield, in US treasury bills. Let's go hide in gold. We saw some sort of upward pressure in gold. Now what the market has got to is actually this could last a lot longer than we were expecting, and we have a need for any liquidity. And so what you're seeing is liquidity getting drawn from all assets, from quality assets, from low quality assets. And so what we're seeing now is US, sort of considered the safest assets in the world, gold and US treasury bills. Those prices are now selling off quite aggressively. And so both in the real world and in the financial markets, people are looking for liquidity.
Ross, it does seem to be that there have effectively been two black swan events. You had the coronavirus and you had a massive fallout in the price of oil. So are there perhaps several sectors that will directly benefit from this fallout in the oil price?
So that's a question that a lot of people are asking at the moment. They're trying to work out who benefits. Could, for instance, plastics companies or chemicals companies or agricultural companies benefit because some of the input costs are being reduced now? So obviously with oil price coming down, maybe plastics companies benefit because their main input is oil. I think that's very sort of first level thinking. So that's the sort of step that the market is making at the moment. You go into a Pick n Pay today and you see the shelves fairly empty. And so what the market is saying is, let's buy Pick n Pay shares because, they're obviously doing very well with the amount of sales that they're making at the moment. I think that's very short-term thinking, and yes, Pick n Pay and the grocery retailers will benefit over the next few months or year. But if you look back, or if you look forward 5 years, actually, they're going to be in a similar position, similar glide path, I think, to what they would have been. So you've actually got to think further. You've got to say, actually, today, what share prices have come down enough that I'm going to make a very good return over the next 5 years, not what is my return going to look like over the next 6 months or 12 months.
Ross, over the last effectively 6 weeks or 2 months, we've seen a rapid depreciation of the rand relative to the dollar. In fact, relative to virtually every developed market currency. That one might think is that how do you manage such a volatile currency in your portfolio? So how do you handle the depreciation of the rand in our equity portfolios?
So we think the rand is very undervalued at the moment, probably in the order of 20% undervalued. So yes, this shock has definitely caused people to raise liquidity, and one of the first places they look is lower quality assets. So take money away from emerging markets, and that's obviously, given South Africa's open economy and that the rand trades fairly easily, that's a place where the market's going to go to try and raise some liquidity. So that puts pressure on our stock market, and that puts pressure on our exchange rate. But that is the case for all emerging markets. If you look at the Mexican peso at the moment, that's selling off massively. So I think, no different to many other emerging markets today. How do we manage that in our portfolios? Well, the one consideration is maybe, do you take advantage of that cheap currency by bringing some offshore assets back to South Africa? So that's one thing we're sort of considering at the moment, particularly in our unit trusts. The other thing is, just assessing the impact on companies. So what we're seeing in particular is a company like Anheuser-Busch, where they are mismatched on their debt versus their income. So they generate a lot of earnings from emerging market countries, but they've funded their business with hard currency debt, so debt in euros, debt in dollars. And those mismatches can put companies under quite a bit of stress.
Over time, earnings drives price in an equity portfolio. And when you have black swan events like this, you'll obviously find that there'll be a very big impact on corporate earnings.
Yeah. So
what is Prudential doing about trying to withstand some of these shocks in their portfolios, their equity portfolios?
So I think the first thing to consider is that what we focus on when we make any investment is a 3 to 5 year time horizon. So when we buy a company, we're not trying to guess what the earnings might do or the price might do over the next year. We're looking on a 3 to 5 year time horizon. So it's very easy to wake up today and say, well, it's obvious that casino earnings are going to be falling dramatically over the next year. Sell the shares of those companies. That might be exactly the wrong thing to be doing at this point, because I think it's now obvious to everyone that earnings of certain companies are going to be going down. The trick for us to work out is what companies come out the other side of what we're seeing in the market today. So that for us is what is critical, is trying to work out which companies actually come out in a decently strong position to be able to return their sort of cash flow earnings base to normal levels again.
So do you see, or do you have to sort of rebalance from overvalued sectors to undervalued ones, or from sectors with bleak prospects to more brighter ones?
So I think what you don't need to do in this market is to go hunting in the extremely cheap sectors. So, you know, given how quality assets have fallen, you don't need to go hunting in the bargain basement. You've got some very high quality assets now at extremely low prices. So I think that's the first point to make. The second thing is also to consider which companies have done very well, or whose share prices have done very well in this environment. So the one company that we are very overweight in is British American Tobacco. They had a capital markets day and, you know, confirmed that actually they've seen very little impact from the coronavirus on cigarette sales. So, you know, there you're seeing quite a strong share price, and, you know, maybe at this point you say, actually, I'm happy to sell some of my BAT shares and invest in companies which are still high quality but whose share prices have fallen substantially. So take advantage of you know, where the market's happy about the earnings stability of a company in this environment, and rather buy companies which are going much cheaper but are equally high quality and have good long-term growth prospects.
So what are you thinking about the equity portfolios in the current environment? What are the big investment opportunities?
I think, you know, if you look at so the first thing to comment there is just generally the markets are very cheap, and particularly in South Africa. You know, if you look at our market, we're now trading close to a price to book of 1. We haven't seen those types of valuations in many years. So we got close in the global financial crisis, we got close after the IT bubble, we got close in the Russian crisis in 1998. Yeah, we haven't seen the South African market get close to a price to book of 1 probably in 40 years. So this is, if you're looking at the market relative to history, this is as cheap as it gets. And so what you don't want to be doing here is to be panicking and saying, actually, you know, what do I need to do in this market? You know, often the best advice actually is to sit on your hands and do nothing. Given where the valuations of the South African market are today, you don't want to be selling equities at this point.
So we've got two investors. And the question really is, what would your advice be to those that are currently in the market, relative to those that have currently got funds to invest? I think you are leading to the point where is it time to invest in equities?
So there I'd say, you know, the first thing that we consider is valuation. So where are we in valuation space? And if you look at the market currently, where we're trading, you know, so you can put together a well-diversified portfolio today in the South African market with a dividend yield in excess of 6%. And for us, it's important to say, well, what are the dividends going to look like in 3 to 5 years' time? And I think what we can say with a fair degree of confidence is that dividends from South Africa, even given what's happening in the market at the moment, are probably going to be higher in 5 years' time. You know, so if you can match a 6% dividend yield in a portfolio plus, you know, some decent growth in dividends over a 5-year time horizon, I think you make a lot of good money. Another way to look at it is to look at the price to book of the market. So, you know, at the moment, the South African market is trading on close to price to book of 1. If you go back only a month ago, you were trading close to a price to book of 1.5. So the market has derated significantly. You know, and you almost have never not made good money on a 5-year view when the market is traded on a price to book of 1. You know, so as dire as the sort of next 6 months or 1 year might look, the market as a whole actually looks very, very good value on a 5-year view.
Ross, we really want to thank you for your insight into our equity portfolios. We really hope that you found that useful. And if you want to know a little bit more about Prudential's equity funds, please contact your financial advisor or contact our Client Services Center. Thank you once again.